Business Finance Unit 4, Balance Sheet 4.1 Balance Sheet Basics. Balance sheet. A balance sheet shows the value of a business's assets and liabilities for a given period of time. It is also known as the statement of financial position. Balance sheet basics. Assets are the resources owned by a business. It includes fixed assets, long-term, and current assets, short-term. Liabilities are debts owed by a business. It includes non-current liabilities, long-term, and current liabilities, short-term. Non-current assets are resources owned by a business that last for more than a year. For example, land and buildings, machinery, vehicles. Current assets are resources owned by a business that last within a year. For example, inventory, trade receivables, cash in hand, cash at bank. Non-current liabilities are debts owned by a business that last for more than a year. For example, bank loan. Current liabilities are debts owed by a business that must be paid within a year. For example, trade payables, bank overdraft. Shareholders' equity, also known as owner's equity, is equal to the difference between a firm's total assets and its total liabilities. Shareholders' equity comprises of 1. Share capital. It is the sum of money invested into the business when investors buy shares. 2. Retained earnings, also known as retained profit, is part of shareholder equity that is not paid to shareholders as dividends. The balance sheet is a standard format that starts with non-current assets. It will include land and buildings, vehicles, machinery, and all other fixed assets that the business may have. These fixed assets are owned by the business more than a year and depreciation is charged. The second heading in the balance sheet is current assets. Current assets means all the resources owned by the business, such as closing inventory, trade receivables, cash in hand, cash at bank. The third heading in the balance sheet is current liabilities. Current liabilities are items that does not belong to the business and the business should return back usually within a year. That is what is owed by the business. In this section we have trade payables, accruals, bank overdraft. The next heading is working capital. It indicates the ability of the business to meet its day-to-day expenses. A safe business will always have more current assets than its current liabilities. Finally, the balance sheet should indicate the capital employed figure. Capital employed is working capital plus total non-current assets. The capital employed figure should always match the total liabilities and equity figure. So, non-current liabilities is another standard heading of the balance sheet. It includes long-term debts that the business has. And lastly, the balance sheet should also show the shareholders' equity heading. Shareholders' equity comprises of share capital, that is ordinary shares or preference shares that investors has bought in the business. Retained earnings are the profits that is kept into the business and not distributed to investors. Importance of balance sheet. Balance sheet helps shareholders to analyze how the business has used their capital to pay long-term loans, to expand the business by purchasing new fixed assets, to increase trading by increasing the inventory and trade receivables under the current asset. Balance sheet helps to calculate the working capital of the business. Working capital is the difference between current asset and current liabilities, and it shows the ability of the business to meet its short-term debts. Balance sheet helps to calculate the liquidity ratios of the business. Balance sheet helps to calculate capital employed of the business. Capital employed is also the sum of non-current asset and current asset minus the current liabilities. Capital employed refers to the total value of assets used to operate the business and generate profit.